Hello everyone, Clifford Bennett, Chief Economist, ACY Securities. Now we know the construction industry in Australia is already slowing considerably, but that doesn't mean there's zero activity. And obviously here at Barangaroo in Sydney, things are still pushing ahead rather strongly. However, this disguises that there are real problems in the current economy. And right now we're looking at US data to come out in the next couple of days, which will reflect what the latest data is on inflation. And I'm expecting that inflation number will be around 9.2%, which is a little bit higher than the last result. But I have to say there is a slight risk it could really be anywhere between 8.5 and 9.5 because a couple of things are happening. One, petrol prices, gas prices in the US have backed off a little bit, and also there might be a little bit of moderation in food price happening. I'm talking at the retail consumer level. Of course, we all know that's happened to some degree in futures markets around the world already. If that inflation number is 9.2 or lower, 9.2 slightly higher, but if it's 9.2 or lower, I think there's a real chance that gold could go through the roof, because the only thing holding gold back has really been the concern of ongoing high inflation, which would mean continuing high and aggressive Fed funds rates hikes. I still think the Fed will be hiking rates, but the market might get excited on the day if that inflation number is only modestly higher or a little bit lower. We could see a little bit of a medium-term top in inflation in the US due to the weakness lately in oil prices. We would like to see those oil prices remain low. If they tick up significantly, then again, we're going to have a resurgence of US inflation towards 10%, perhaps 12% as I first forecast many months ago. But for the moment, there is a chance of a high here. That doesn't mean we should be all out buying equities though, in sort of a big rush, because whilst inflation may peak, the damage done to the US economy and other economies around the world is very real and ongoing. So do not think that a lower inflation rate or a peak in inflation necessarily means the Fed stops hiking. It may well continue to hike rates, because really anything over 5% is a bad number from an inflation perspective for any economy. And therefore, even if inflation fell back to 7%, if it remained there stubbornly, the Federal Reserve would probably keep hiking rates just the same. Remember, interest rates are probably still on the stimulatory side. They have to get back to neutral and move to restrictive before the Federal Reserve will even think about slowing down on its rate hikes. But on the day, if that inflation number is encouraging, you can be sure that equity market traders will be enthusiastic, and we could see some real upside momentarily in stocks. However, the price action yesterday, we did see Apple do a classic price reversal, one-day reversal, which is one of the more reliable technical analysis indicators actually, so it's well worth paying attention to. You could almost short all of the US equity market at the moment, and if Apple makes a new high beyond yesterday's high, then stop out. So that's a fabulous risk-reward opportunity, and certainly one worth considering. On the currency front, Australian dollar keeps getting bought, but I'm not sure why. It did have a fabulous trade surplus, but that is to be expected, and that was more about imports being soft, as well as exports being still quite firm and shooting through the roof actually. So it was a momentary buy Australian dollar signal, but the fact is, on the interest rate front, the Fed will continue to hike rates more aggressively than the RBA, even if the RBA is hiking, and therefore the interest rate differential will continue to grow. So I'm still a bear on the Australian dollar. And for Europe, why people are buying European equities, I'm not sure. There is a tale of two economies developing though, where the wealthy seem to be not fazed at all by the current global economic slowdown, whereas it tends to be less affluent who are really feeling the pain. And that's why luxury sales and that sort of thing are staying so strong, even though some consumers, most families, are really struggling in the current environment with both food and energy price gains. So overall, I'm still very cautious on equities. I think they could be headed lower. I'm still very cautious on this Australian economy. don't get too excited and carried away with just because the US inflation number might be stable or encouraging that means the Fed has stopped hiking, or that the RBA has stopped hiking, or that there's no more damage being done to the underlying economies wherever inflation is strong. Thanks very much. Clifford Bennett, Chief